Hello everyone, welcome to Prime Investor. In today's video, we are going to answer some key questions. Which is the best SIP fund? Which is the best lump sum fund? I want to invest in SIP, which is the best fund for me? Okay, so we are going to tackle all these questions in the next few minutes. Let's start with the basics. What is an SIP? You will say, if it's simple, you just invest a fixed amount every month, and that's an SIP. Correct. But what is often forgotten is that an SIP is a method of investment. It is not an investment itself. You invest through a SIP in a mutual fund. So you don't invest in SIPs and mutual funds. You invest only in mutual funds, except that you're investing in that fund through an SIP. Okay. So why is an SIP great? Why is it useful? Okay. There are some very key benefits to an SIP. The first is that it brings in discipline in savings. It makes sure that your investments are made. It makes sure that you don't spend all your money at the end of the month and go, I have no money left to invest and let me just invest next month. Right? So it makes sure that some money from your income is getting deployed in investments and growing and building your wealth. So that is the main benefit, which is that of bringing in discipline in savings. The second is that it lets you invest small amounts and therefore, build your wealth gradually. Most of us, our goals are not going to be small amounts, saving for retirement, saving for children's education, saving for a house. All these are not small amounts. So if you have to achieve that large lump sum, you need to start early, or you need to invest smaller sums which will gradually get you to that big amount. So that is what a SIP helps, because you can invest as little as even 1,000 rupees if that is all you have. So it lets you build up your wealth gradually. The third benefit is that by making sure that it's invested every month, it reduces the risk that you mistime your investments. Whether markets are at a high or markets are at a low, your money is being invested at multiple market levels. And actually, it is this third benefit of investing at multiple market levels that is often, completely blown out of proportion, because the belief is the rupee cost averaging, right? Where it is often believed that if you have an SIP, you will never have losses. Or if you have an SIP, your cost will be very low. Okay. Now, one thing you need to understand about this cost averaging is that if your investment cost has to actually come down, you need a deep market correction, and you need this correction to last long enough so that every additional investment you make is made at lower and lower levels. Okay, let's take an example. Okay, here what we did is to take the UTI Nifty 50 index, because the Nifty market, we are not being biased by taking specific fund performance and all that. Then we assume that you run an SIP of 10,000 rupees in this index for the past 5 years. Now, if you see, this orange line is the fund NAV, and this black line here is the average cost of investment per unit, right? If you see the initial part, no matter, even when the markets fell, your actual cost is trending generally higher. It's not actually trending lower. Even with this steep market fall here in early 2020, your costs are actually not being lowered by any significant extent. Okay. Now that the market is taken off here, then the market is much higher. Your NAV is much higher than your average cost. But as and when this rally continues, your average cost is going to trend higher and higher. So the ability of your SIP to actually bring your total cost down depends on how steep a market fall you have invested through, how long this market fall has lasted. If you have run SIPs for a very long time, it's going to get harder and harder for you to bring that average cost down. So don't place so much of emphasis only on this bringing the cost down and averaging benefits. Always look at the total benefit of what a SIP does, which is discipline in savings, lets you build up your savings gradually, build up your wealth gradually, and it reduces the risk that you mistime the markets. You don't put in the chunk of your money when markets are expensive. You don't miss the market lows. You don't miss opportunities when you are running a SIP through multiple market cycles. Okay, so don't think that an SIP is a cure-all for everything. So that is SIP. Now let's come to lump sum. Lump sum is simple. You invest a chunk of money at one time in a fund. This is also a method of investment. You invest in a lump sum, you invest through a lump sum in a fund. You invest through a SIP in a fund. Okay, so lump sum is also a method of investment, SIP is also a method of investment. Now, in a lump sum, what is important is that it's not a one time investment. You don't make only one lump sum and stop with it. You can make as many lump sum investments as you want. As in, when you have a surplus, you can make a lump sum investment. It's not actually wrong to make lump sum investments. It's not like SIPs are fully correct and lump sums are fully wrong. Okay. What is the risk with lump sum? Of course, is the timing that you get in when the market is high, that you don't know when the market is high. So, to avoid this risk, what you need to do is to make sure you invest at multiple market levels. So, don't just invest once and then completely forget about it. Make sure that every time you have a surplus, you invest so that you get different market cycles and you reduce the risk that you get in at the wrong time. Okay, and actually there are some cases, where lump sums are the better way to go, or where SIPs will really not work. For example, say your income is fluctuating every month. You can't commit to a fixed SIP. In such a case, you can make multiple lump sum investments every time you have some surplus. Or if it is, thematic funds. In thematic funds, SIPs actually don't work because you're investing at higher and higher levels. If you get in at the bottom of that sector or theme cycle, you're actually going to make a lot more than if you did it through an SIP. So lump sums also have their uses. They are not wrong. They are higher risk in terms of mistiming the market, but as long as you make multiple investments, that risk is also mitigated. So what you need to bear in mind is that an SIP is a method of investment, a lump sum is a method of investment. The question you should be asking is not what is the best fund for an SIP. What you need to be asking is what is the fund? Because in both an SIP and a lump sum, the actual investment is the fund. It is not the SIP or the lump sum, right? And your returns come from the fund's performance. So if the fund is not going to be a good performer, if it is going to be a fund that trails the benchmark or trails its peers, your returns are not going to be up to the mark, regardless of whether you put it through an SIP or put it through a lump sum. Right? Take an example. Here we have considered Franklin India Blue Chip. Because that's a fund that has been consistently being unable to beat the Nifty 100. So we assume that you invested 10,000 per month in this through an SIP for 5 years, or you made a lump sum investment 5 years ago, right? So regardless of the SIP or the lump sum, as you can see, it has not beaten the index. But if you took, a steady outperformer, some other large cap fund, that has been able to beat the Nifty 100 or its peers, whether you invested through the SIP or through the lump sum, your returns would still be good. Therefore, the important question to ask is, how good is the fund? Is it a quality fund? Is it a fund where the strategy is such that it can continue to beat the markets, continue to beat peers? Okay. So there are no best SIP funds or best lump sum funds. There are quality funds that can be invested in and which can form a part of your portfolio. Once you identify a quality fund, you can decide whether to invest through a SIP or through a lump sum based on what is convenient for you. So if the benefits of a SIP, which is, the automated investment, the disciplined investment, the small amounts growing to a large amount, if this convenience is what appeals to you, then invest through an SIP. Otherwise, invest through a lump sum if that is more convenient for you, but make sure that you have multiple lump sum investments. Okay. So What you can also do is to have a lump sum and an SIP. For example, you can run an SIP in a fund, and in periods of steep market correction, like in early 2020, when you know the market is corrected, you can quickly put in a lump sum investment and emphasize that investing at lows. So the question you need to ask yourself is not, is this the best SIP fund or the best lump sum fund? You need to ask, is this a quality fund? Is it a fund that is a consistent performer? Whether it's equity or debt or hybrid or whichever fund you're looking at, first understand whether the fund is good enough for you to invest in. Then you can decide whether the SIP is more convenient for you or the lump sum is more convenient for you. A SIP is easy because it brings in that automation, brings in that discipline, it lets you invest small amounts and grow your corpus. If you're doing a lump sum, you need to make sure that you invest at multiple market levels. So what you can also do is to, you can invest in, just because you're investing in SIP doesn't mean you shouldn't invest in lump sum, or vice versa. So you can be running a SIP and you can use periods like the market correction in early 2020 to put in that lump sum at that market low and increase the effect of investing at those lows. Okay, so don't be swayed by claims of best SIP funds or best lump sum funds, right? Always understand whether the fund is a good fund which you can be holding in your portfolio, and then invest in it through whichever method of investment you want. Okay, so that's it for today. Don't forget to subscribe to our channel for more such videos on investing in equities, in mutual funds, in insurance, and all other products. And do check out our website, primeinvestor.in, where we have multiple tools and articles and recommendations across personal finance products. Thank you.